Hello, everyone. Thank you very much for being with us today. After having welcomed 7,000 participants that have joined us from all over the world, we are truly happy to welcome you back on board for our third season and very second episode of 2021 on the 360 degrees of fundraising, focusing today on the Venture Capital Manifest 2021. In last and 5 episodes, we're covering the full value chain of accessing funds and in Luxembourg and beyond, continuing today with our private investors, entrepreneurs, and brilliant VCs. A little bit about their fantastic background. He wears sunglasses and he's one of the most mysterious men at the loft. Ladies and gentlemen, Mr. Pascal Bouvier, co-founder and currently managing director of Middle Game Ventures, is with us today. Pascal co-founded the Rectad Lab, the European Fintech accelerator, and was previously a venture partner with Santander Innoventures and a general partner with Route 66 Ventures, where he built the firm's venture arm into an impressive top 20 global fintech investor. Ms. Pauline Brunel is investment manager at Blackfin Capital Partners. Previously, Pauline was a senior associate at Impression Ventures, co-founded and co-chaired Women in VC Canada. She's also member of the board of Time for the Planet, a non-for-profit using entrepreneurship to fight global climate change, and a dear member of the Talent Roots European Coalition to Foster Fintech Development. Mr. Max Mears is our general partner at Fabric Ventures. He spends his time looking at new investment opportunities and helps portfolio teams with things like network design and token economics. Max also looks at after a number of Fabric portfolio projects, including Casa, Keep Network, Oskin, and Open Zeppelin. Pavel Kuskowski is the co-founder and CEO of Coin Theorem. Pavel is a recognized authority on compliance issues in the cryptocurrency space. He's an ex-global head of AML of Royal Bank of Scotland and an expert in compliance and anti-money laundering, as well as a sought-after speaker who has appeared at top industry conferences. On the moderator side, we have my dear colleague Alex Pelican, head of partnerships and ecosystem development at the Loft. Prior to joining Loft, Alex was teaching as a teaching associate at the University of Montreal and a serial entrepreneur running businesses in the space of e-commerce and alike. At Loft, he's used to travel the world, connecting entrepreneurs with the local fintech ecosystem, and has interviewed thought leaders from all walks of life. Ladies and gentlemen, the screen is yours.
Thank you so much, Anthony. Thank you for the great introduction. 4 minutes gives you an idea of how big is the background of our speakers today and how impressive the CV is. So hello, everybody. Thank you for being with us for our second masterclass on funding. This one is going to be specific to venture capitalists. So I know that there is a huge interest. We already have 41 participants online. So we're going to have with us the best VCs who are investing in fintechs in Europe. So we have Middle Game Venture, as mentioned by Anthony, Blackfin Capital, my dear friend Pauline from Paris. She's based in Brussels right now. Fabric Venture, and also one entrepreneur that raised money. He's in a fintech, he built a fintech, and thank you so much for being with us, Pavel, today. So yes, Pauline, Pascal, Max, guys, welcome. As you know, we try to make our masterclass as interactive as possible. So we're gonna have a very brief chit chat about you guys, what are your funds, what kind of companies you are looking for. But the best part of it will be the workshop. So for the participants today, you're gonna have 2 workshops, how to pitch VCs and how to raise money with VCs if you are fintech, and another workshop dedicated to blockchain companies, because blockchain is a huge part of our ecosystem today at the Loft, and most of entrepreneurs are telling us it's very hard to raise money while you are in the blockchain sphere because most VC don't understand you. So stay with us, it will start in about 20 minutes. So yes, let's start with the lady. We are gentlemen in Europe. So Pauline, let's start with you. What's Blackfin and what you guys are doing?
Sure. Hi, everyone. So I work for Blackfin Tech, which is the venture arm of Blackfin Capital Partner, more traditional, I would say, private equity firm focusing on financial services. At Blackfin Tech, so we're focusing on fintechs. We invest in fintechs all over Europe. We invest from seed all the way up to Series B. In terms of check size, that would be from like 1.5 all the way up to 15, pretty much. For a first check, we invest in equity only and lead or co-lead rounds. That's basically what we do and how we do it. We don't specifically focus on any sub vertical. We would invest in everything that disrupts the financial services in some form of fashion. That's about it.
No, perfect. I will stay with you. When you say you invest in fintechs, it's going to be more B2B fintechs or B2C also, payment?
Yeah, it's a good question. There's some funds tend to focus on one or the other. We don't. So far, our portfolio is pretty biased on the B2B side, I have to say, but it's not done on purpose. It's just the way it is. So we don't focus on B2B or B2C. We're actually interested in everything, B2B, B2C, B2B, B2C, whatever, you name it.
Okay, thank you, so Pauline. I will come back to you in a few seconds. So Pascal, you are next in line on my screen. I have to say, Pascal, your beer matched perfectly your background. I don't know how you found that background, but it's perfect for the occasion. So Pascal, tell us a little bit about Middle Game Venture, please.
Thank you very much. Hello, everyone. Gira?
Yes, we can hear you. Go ahead.
Well, I'm talking to Gira. I see Gira on the, I want to say hello.
Okay.
Thank you very much for bringing your cat. I love cats. I think as a rule, every panel that I should be on from now has to have a cat. What's your cat's name?
It's Rory.
All right, very good. We have Rory with us. We invest in B2B startups and B2B2C startups, heavily focused on capital markets and asset management and the future of these two spaces. We're not limited to these two, obviously. We look specifically to the crossover between the traditional financial services industry and the crypto world as it is evolving right now. That includes DeFi, but not necessarily only DeFi. And as it crosses over to a future of digital assets, where any and all assets that we know of, financial assets, physical assets, plain vanilla, and structured assets will be issued in a much more crypto-ish way than they have been issued in the past, which means that the market structures of pre-issuance, at issuance, and post-issuance, as well as workflows and processes, will be re-architected in a certain way. So that's one of our main focuses. The second main focus is on what we dub the future of financial services to be open finance, right? We've heard of open banking, focus on the checking account with PSD2. We've heard of like APIs, either primitive APIs or APIs have as they've matured and become sophisticated. And one of our premises for the future of the industry is that everything is going to be open, right? So APIs not only around the checking account, but for provisioning, ingesting and digesting any type of product for wholesale, for corporate, over and beyond simple products, which are around data, around credit, and around savings. Just think of like going to a website tomorrow, plugging in whatever you need to plug in on your website, pushing 1 or 2 buttons and buying a share of Apple, rather than like the convoluted process that we have right now, or a mortgage, or securing an IP, and so on and so forth. Open finance. And I'll stop there because there's much more.
Perfect. What are the ticket size, Pascal, usually?
We invest post-seed, so a startup needs to have closed a round that it can call a seed, all the way to B. So our range is 1 to 4 million as a first ticket, obviously with follow-ons.
Perfect. Thank you so much, Pascal. Coming back to you in a few seconds. Max, the floor is yours. Tell us everything about Fabric Venture, please.
Thank you. So I think Pascal took a lot of the thunder already. We share quite a few sort of common thoughts and trends on the investments we make. But Fabric, in brief, is a venture capital fund that is adapting to the needs of what we call the open web, or Web 3.0, or the blockchain space, depending on what nomenclature you want to use. But it's based on the thesis that today's internet business models are really largely based on the ads tech model, which is based on closed economies where large tech players take their users' data and monetize it on their back. And we also based the thesis on the fact that in the future, every single asset that we know of today will exist in some digital format, whether that's a financial asset, a data asset, a social asset. And that with these sort of technological primitives that have been developed in the blockchain space over the past 10 years, this idea of peer-to-peer trust and sovereign ownership of provably scarce digital assets, we will be able to actually create new business models for the internet that are much more akin to the internet, that actually fit the internet much better, but also reward the content creators, the value creators, the data creators on open economies that are generated by the internet. And so that's the core thesis of Fabric Ventures. The sort of core focus is the European market. We tend to focus at the seed stage. There's rarely things that are too early for Fabric. We tend to look at teams when they have an idea but not necessarily built out a full product yet, or not necessarily gone to market yet, all the way to some of the early sort of Series A stages.
So what would be the ticket size for you, Max?
So ranging between 250K up to 1.25 million on average.
I can come to you without any, just an idea, no market, nothing. Just the product build, but no market yet.
That's when we like talking to people first, indeed.
Oh, they would love to talk to you too, I guess, at that stage, because usually it's not the case for most VCs. Okay, thank you so much, Max. Back to you in a few seconds. Pavel, Coin Theorem, one of our members. Happy to have you with us today.
Thanks, Alex.
Tell us a bit about Coin Theorem, how much money you raise. I don't know, part of it's official. I don't know if you want to disclose something new, and with whom and how, most important.
Okay. Yeah, so Coin Theorem is analytics and compliance company powering the mass adoption of blockchain. So I like what Max and Pascal said. That's exactly the thesis which we strongly believe, and we see market going into this direction. And considering that out of 3 VCs on this panel, we have 2 VCs strongly believing that this is the future. We actually, I think, in a pretty good spot in terms of fundraising at the moment, right? Historically, I mean, so what we do in general, we analyze data related to crypto transactions. We, apply our algorithms and we provide data which makes, really meaningful outcome, mostly around compliance, anti-money laundering. So that's my background. But also, adding more sophisticated tools like assets tracing and recovery with our service Reclaim Crypto, which is very successful, but also adding new structured data, such as, for example, credit rating. In terms of where the company is, in terms of fundraising, we've done Series A last year, primarily of around 6 million altogether. That's primarily coming from UK VCs, but also from Middle Game Ventures. So this is an over connection to Luxembourg and to this panel, right? So I have to be careful what I say about connections with VCs here.
No, but that would be my question. How did you manage to get money from Pascal?
Yeah, I mean, that's tough, I tell you. No, I think, we good company, we growing company, the sector is, I think, really fantastic, so it's more about, having good partners as well. And I think, this was definitely fitting, a fitting match.
Listen, how do you approach a VC and a VC like Pascal? Usually they found you find them, you drop an email. We will ask also the other VCs how they want to be connected, but how did you guys manage at Coin Theorem?
Yes, I mean that's a process which is lengthy, I would say. I think for Series A, we ran over 100 different VCs, to get the proper one. So I think that's the number which you need to be ready, especially for some earlier rounds. I think moving forward after Series A, it's easier. But I think it's a combination of mutual interests, combination of VCs coming to us, combination of outreach. So that's something which historically is coming. Again, after Series A, it's becoming easier because you start to have connections, and you start to have VCs which are saying, okay, this is good company and worth investing. So I think this is it's like almost snowball.
What is the main question VCs have asked you? VCs like maybe Pascal, and I will come back to Pascal after. What's the key point they were focusing on? It was what? Traction? It was
traction.
Team?
Yeah,
what was
traction,
what was the discussion?
Yeah, traction, revenue. That's main points. I think luckily or not luckily, 2020 and 2019 was the time when revenue was important, and revenue was it's not like you have idea, brilliant idea, especially in Europe. I think it doesn't fly too well. You have idea and you have some tractions, and the idea could be great, but you don't have really revenue. So I think the difference between European and US VCs would be that in US that could give you really good traction, not having revenue, but in Europe revenue traction is key.
Thank you so much, Pascal. You confirm this is the kind of stuff you are looking for when you screen projects?
I won't comment specifically on the Coin Theorem and Pavel. We don't usually do that. So other than Coin Theorem and Pavel are great, which is why we invested in them. At the stage that we invest, we need to know and to ascertain that there is already product market fit. So along with product market fit, there's a whole host of various indicators that show a certain level of maturity for the startup, which is either an exhaustive or non-exhaustive format would be too long for this current panel. But we look at that, the product market fit. We look at the various levels of maturity on the technology, on the team, to make sure that the product market fit is backed by something that is tangible. And then the aspiration is to figure out how soon or how long until product market sales fit, right? On the basis that there is already some revenue, and how replicable that revenue is going to be in a way that doesn't bankrupt the company because it's going to be too expensive. So these are kind of like the two things that we're looking at in terms of the business model and where they are commercially. The last point I would say is, obviously the team, even though we don't invest in super early startups, the team is still very important. So figuring out how they solve problems, what the weakest link is, if there are holes that need to be filled in the org structure, how they work together, how they work with investors. And that's more psychology and forensics on human behavior than anything else.
When you speak about traction and revenue, is it a threshold and you say, okay, they reach 100K and then it's good for us? There is a cap you put?
The short answer is it really depends. It depends on the business model. It depends on who they're selling to. It depends on the pricing and revenue model. And there's no one size fits all, right? Okay.
Thank you.
It could be a minimum of 1 million at like around 100K in MRR. It could be more, it could be less. It could be also buttressed by the pipeline and how mature the pipeline is. So I hesitate to say this is it, and this is the silver bullet.
Perfect. Thank you so much, Pascal. Max, I mean, you are quite a different animal on this panel. How can you evaluate a company if they don't have traction yet? What are the key metrics you are looking for?
No, absolutely. And this sort of links back to the adaptations that I think are needed for the venture capital world to play in sort of the open web investment space. There will be companies, protocols, networks that you want to invest into that don't generate traditional revenues as a company would in the sort of traditional sense. You might want to invest in them when they haven't launched yet. You might want to invest in them when they have a set of contributors that you rate very highly and who have established that there is a clear problem that they will set out to solve, but that they haven't fully solved yet. And so it often really comes down to the team and what they have done before, what sort of partners they are working with, the space that they are going into, and almost most importantly, alongside the team, the timing of what they're trying to do. I think we've learned our lesson by making a couple of investments early in the sort of 2016-17 wave that are now playing out, but faltered back then, and making sure that we are able to ascertain that what they are building today will fit into the ecosystem, into the maturity of the ecosystem, will be able to plug into the other tools. If we think about the DeFi or the decentralized finance space, for example, which has really gotten a lot of adoption over the past year, a lot of ideas that are being built today, and very successfully so, were attempted in 2017 and didn't play out at all. So those are some of the elements that we really...
Do you have a specific example in mind, Max? I mean, I don't know, you spoke about decentralized economy. Decentralized exchange is something that we are quite familiar with at the Loft. Do you have any specific example in mind?
I mean, without naming any names in particular from sort of 2017 wave, but a lot of teams were trying to build decentralized exchanges in 2017 that, for example, did some interesting innovation on the design of how that would work, but they didn't catch on traction. And then there was this one small sort of unlocking, or one small idea, which was that instead of trying to hope to find a purely peer-to-peer model where if I want to sell an asset and you want to buy it, it matches us and we have a trustless exchange of that asset, that is an issue because the likelihood that we match at the exact same time for the exact same amount is very low. And so there was this one innovative idea that came into 2018 to 2019 with Uniswap, which was an automated market maker, which effectively was a peer-to-pool basis, where there could be a pool of liquidity that anyone could trade into and out of on a trustless basis. And that completely exploded the market. And for example, Uniswap has done $6 billion of volume over the past week, whereas things like 1inch are doing $2 billion of volume over the past week. These are numbers that were just unheard of 2-3 years ago, but were on very similar ideas, but just at much better timing.
Yeah, it's quite impressive. Thank you so much. Thank you so much, Max. I mean, we're gonna learn more during the workshop with you. Pauline, back to you. I mean, I don't know what's going on. You know, with the COVID. Last year, a lot of VCs we speak with was about, okay, saving the current portfolio, not really looking for investment. And since the beginning of the year, we see huge investment in some of our fintechs. I mean, the market is just skyrocketing. 3 trillions have been invested in different IPOs and funding in US. I mean, how did you adapt it to the situation, and what's going on in the market? Because I mean, is it a bubble? What's your insight, Pauline?
It's a good question, and I think we'll all have a different view on it. But so on your first question on what happened with the COVID crisis, so when it hit last year, it took us like a few weeks, even a few months, I would say, like two months, to just realize what was going on. And we kind of stopped investing and focusing on our portfolio companies, because you, like, at the end of the day, you want them to succeed, you don't want them to die, you don't want them to run out of cash. It's like, what can we do to help you? What's really the main focus? Where are you? Like, what is your cash situation? How can we help? That was the main, the main priority. And then as like any other investor in the market, we needed to go back to the fundraising stage, right? We need to deploy our fund. We have a fund to deploy, and there's more money on the market than ever. So we were like, companies were back on the fundraising scene, and we saw some like great companies raising money during the summer and then during the autumn season as well. So we just like beginning of the summer, we went back to that kind of fundraising priority, investment priority. So that's how we kind of dealt with that. It's true that it was a bit hard in the beginning to invest in founders that we were not able to see, because yes, when we invest at Series B stage, it's very likely that we've met with the founders before already during a previous round at some point at an event. But when you invest at seed, it's very likely that you never had the chance to meet with the founders. So how can you invest in a team that you're not going to meet with was something we had to adapt. And we adjusted, right? Like we closed 2 rounds over the summer with like founders that we didn't met before. It was brand new for us. There's a lot of Zoom calls and a lot of everything, but it's a bit different. Like the relationship building is a bit different on the VC side, but as well on the founder side. How can you be sure that you've selected the best investor, the right fit for you, right? So there's a lot of relationship building that is going on in these Zoom calls that is brand new to us. But now we've adjusted to that and we're fully deploying our fund and adapting in this situation. So that what is going on in the market, because at the beginning of the crisis, we were thinking, okay, it's going to be very hard for companies to raise any money. How are they going to do that? And now we're seeing companies that are like pre-launch raising tens of millions at like valuations, like skyrocket valuations. So what is happening in the market? I think there's like what I said is there's more money on the market than ever, with funds that are delayed in their deployment on schedule, as well as more money, like more VC funds, more like pocket of money. So there's a pressure to deploy money. That's one thing. And then the second is, just great companies. And how can they raise money? Well, as soon as you have a sort of KPI, like something to show, sort of traction, some KPIs, you have a strong team. Well, just a strong team can raise money just on an idea now. I mean, and maybe an MVP, but as soon as you have something to show, then it's going to be way easier for you to raise money. And then the competition between funds is going to start to increase. It's a different game when you're like a first-time founder. You don't have the network, you don't have KPIs. It's a different game. But the skyrocket valuations that we're seeing at Series A or B stages are from founders that have a strong track record, have KPIs to show, and then you have like tens of funds that are competing to invest in this type of companies. So
do you mean that it's going to be easier to raise funds? One of the things, I mean, for the last 3 years, we match some of our fintechs with funds like yours, and we help raise for them around almost half a billion. But when we see some, pitch decks saying, okay, I want to raise, I have no market share, I have no traction whatsoever, and I'm raising 3 million for 10%. Is it something that, I mean, it's going to be easier to have this kind of conversation?
No. Valuations still match the amount that you raise, right? So what we're seeing is companies that are like feeling the momentum, right? They are gonna like build business plans that make you think they need 30 million when actually they need 10, and the valuation is gonna match that amount, so that the actual like dilution target is gonna be around 20%, like in every single round. Sometimes it's 25, sometimes it's 15, right? Depending on where you are, but on average in the market, you kind of like reach that 20% like kind of target per round that you're raising, like total amount. So if you raise 3 million, yes, you want your valuation to kind of match that 3 million. But like pre-revenue raising 3 million, right? It all depends. If you're building the Hyperloop train, right, you may need 3 billion to be able to launch your company before you actually have revenues. If you are launching a fintech, it's most likely that when you raise your 3 million round, you already have an MVP. You already have a sort of traction. You already have something
to show for. Yeah. Yes. Perfect. Thank you so much, Pauline. Pascal, you want to add something? Go ahead. No? Is it going to be easier to get money from Middle Venture, from Pascal Bouvier?
As long as you're a great team, yeah.
Good. Max, what's your insight? How you guys see the future?
I fully adopted and adapted, I think, to this sort of virtual business setting. I think a lot of the teams in the open web space have worked on distributed basis in the past anyways. A lot of the open source community has always worked on projects collaboratively, but from different areas without necessarily even knowing each other. I think if we look at the sort of flat out two greatest investments over the past 15 years that anyone could have made over that period of time, it's probably Bitcoin and Ethereum. With Bitcoin, you don't even know today who the founder is. With Ethereum, you probably would not have met the team when you could have made that investment. So
you are in the blockchain sphere. I mean, we have one question in the chat and then we're going to jump in the quiz. Is the pros and cons of ICOs? I'm surprised that people are asking this question because Alexis, I mean, we don't see so many ICOs anymore unless I'm not paying attention. What's your insight, Max, regarding ICOs? Is it something that you are looking for? Something you advise?
I mean, it was an element of the sort of 2017 cycle of the whole blockchain investing space. I think it had some benefits because it poured a lot of capital into some really good projects and companies. The issue is that they were done on a very unconstrained basis. So people who were not necessarily professional investors that did not necessarily go deep into the different projects were pouring a bunch of money based off of marketing, not based off of actual tech. And so what we've seen recently is that the term ICO has really fallen away. And but more importantly, it's not so much the terming or the naming that matters, but rather what sort of sits behind it in terms of the tech that's being built and what is being financed. So the idea behind the ICO was that you could do an initial coin offering, and anyone who would use the token in the future would basically have access to it and could buy it on the open market. What we realized is really
it can help. That's a question of Alex. It can help in a
judgment. In its former form, it does not really help. I think what we've evolved to today is actually really helpful. It's the realization that if you have a token that is well designed, that mimics equity in the form of effectively being a representation of cash flows in a network instead of a representation of cash flows in a company, it is important to get that token into the right hands. You want to get it into the hands of the service providers that will provide the services and the value to your network. And those are not the speculators that are buying an ICO and selling it sort of three days later on an exchange. Those are the people that will be providing bandwidth to your network, people that will be providing storage, something like Filecoin. And it's important to make sure that those people and those entities hold a stake in the network. You get them aligned, incentivized. You build an army of missionaries rather than an army of mercenaries, which is what ICOs really pushed at the time. So I'm glad that we've moved away from that.
Perfect. Thank you so much, Max. We're going to have to jump on the quiz and then the workshops. That's the most important part. So I would like to thank our panelists. But first, one last question for Pavel. Pavel, what's the best advice you have received as an entrepreneur, or what would be the best advice you would like to give to entrepreneurs who are looking to build a company and raise money?
That's quite two different topics, I would say. I mean, definitely focus on growing real business as opposed to something you think it's real business. That's one part. For fundraising, be prepared. So I think that's actually really helpful in the process of get ready in terms of documentation, the deck, train people in your team to actually have the same communication and it's communications. I think being prepared, that's most topics when you need to cover in terms of fundraising.
Perfect. Thank you so much. Thank you to our dear panelists. I will let Anthony jump with the quiz, and then we'll take everybody in the breakout room. Thank you so much, Pauline, Max, Pavel, and Pascal. See you in a few minutes.
See you in a few minutes, guys. So we want to see whether you've paid attention during the panel discussion. For that, all you need to do is to click on the access link and put your last and first name. I can hear that already the first people are popping in. The quiz is going to last 3 minutes only, so you need to hurry up if you want to score the most, and the 3 top people will be showcased. Okay, so we started about 30 seconds. I want to see more people, so we already have 20 people participating. 25. Let's go. Let's pass. I want to see 30 people. 27. I want to see 30 people. 2 more. And then we start. 2 more. 1 more. Last chance to register. Last chance. Let's go. Okay. Here we go. Alex, you can't. That's cheating. Okay, Anonymous is first. Congratulations, Axton Uriel. Please introduce yourself.
Hi, can you hear me?
Yes, you can on-screen yourself as well if you want.
Yes, definitely.
You got 30 seconds.
So thank you very much for this opportunity. I'm actually out of Israel, born in Belgium. Have been in Israel for the past 15 years and co-founder of a company dealing in data science, focusing on the financial industry, making sure that all access to data or transfer of data is being done in a very compliant way, according to regulation and policies. Happy to connect on LinkedIn or however you want, if it might interest any of you. Thank you very much, guys.
Thank you, Uriel. So what are we going to do next?
Congrats, Uriel.
Thank you. What we're going to do next, we're going to open up the breakout rooms. Every single one of you has received an invitation to join one of those 2. Please, if you have the latest version, you'll be able to assign yourself. Just click on breakout rooms and assign yourself. If you haven't, we'll do it for you, but it's going to take a few minutes. The workshop is going to start in a few minutes. Okay?
Right? So a quick example I like to give is when you invest in 10 companies at seed or Series A stage, the odds are that like 5 of them are going to die, pretty much. 2 are going to do like time 2, 2 are going to do like time 3, and 1 is going to be like time X, right, on return. So you really need that time X to be able to return your funds and offer an IRR to investor that is actually higher than investing in a stock market or investing in real estate. It's way more risky. So you really need that time like 30X to be able to like have an IRR that is higher than the market. So that is why when we invest in a company, we're looking for there's a path to the $1 billion company. It's going to be hard, but there is a path. So there needs to be like some growth expectations that are really high. That's like one key message. So if you're not like on that path, then the VC money may not be the right type of money for you, right? If you are not looking for that. The second point is split the pie, right? If VCs invest in equity, equity is going to cost you some dilution. So yes, if you are gonna increase the valuation of the company substantially, then it may be better actually to own 20% of a 100 million company than like 1 million of like 100% of 1 million company, right? For sure. But it may not be the case if you're not willing to grow the company at a significant stake, right? So maybe the equity is not the best type of investment for you, and maybe the non-dilutive type of investment can be better. So these are 2 types of key messages that I wanted to start, like why looking for VC money. And VC may not be the best solution for every single company out there. And it's not personal. It's really either a fit in terms of growth and dilution impacts on your side. Second is when, and I'll be very quick on that slide, because I think you kind of like know everything here already. As when venture capitalists typically invest. So you have funds that start from pre-seed and all the way up to Series C, pretty much. That's where venture capital funds typically invest. I think the really important message here is that VCs typically focus on 1, 2, or maybe 3 stages. Like you don't have the same fund that is going to invest pre-seed and the same that's going to invest at Series C+, right? It's not the same the same type of investors, because the risk reward again is a bit different. It requires as well skills that are very different, and to get the best support from your investors as well. Like your best investors at Series C to help you may not be the same guy at the pre-seed stage, because you will not have the same kind of challenges ahead of you. So really looking for the venture capitalist that is going to fit your stage, and that will usually happen from pre-seed up to Series C pretty much. I guess that's the perfect bridge to my next point is, for example, we're a fintech-focused VC fund. You may have health tech-focused funds. You may have generalist funds that are industry agnostic. But the thing is, you have focuses. You have, like, it could be industry, that could be expertise, that could be anything. So the focus is really important. So you need to know who your VC fund is before you're actually going to pitch that fund. I put like a sentence in the middle of the slide that says, we say no more than 99% of the time, which means that as a founder, it's really hard to get a yes. Even if there's money on the market, it's gonna be hard. So you don't want to waste your time pitching a healthcare fund if you're a fintech company, right? That may sound basic, but we usually get pitches from companies that are not fintech, even if we typically say that we focus on fintech. But it applies to the geographical coverage as well. If there's a competitor in our portfolio that is actually a close competitor, as well, if you're looking for a lead role in your fundraising round or a follow ticket, you may not pitch the same type of investors. What else do we have here on the list? Yes, the fund life stage. This may be a bit more tricky to get in terms of information, but when as the fund you're reaching the end of your investment period, you may not have the same pockets in the sense that you may not look for very early stage companies at the end of your life cycle. You may look for more later stage companies. You may not have the same amount of money that is available. You may not have, so it's really something that is, to take into account as well. The last point is, it's okay to talk to associates. I know some founders try to bypass juniors at firms, but that's the way it works, right? So you have more junior people that are doing usually the first screening, the first call, the first whatever, and it's totally okay to talk to them. If the conversation goes well, like the second call is going to be with an investment manager, director, whatever, it's going to be that. But don't try to bypass. It's totally okay, and that's the way it works. And they are a great person that do a very hard work of getting a lot of calls every day. So anyway, so don't be upset by it. And finally, how I think we can go to that deck, and then it's an intro to our actually conversation, is how you are going to reach out to VCs. We do have 4 ways of getting in contact with companies. The first is inbound. We get a lot of inbound from companies directly from in our website, from our LinkedIn, or like it really doesn't matter, but we get a lot of inbound. We also do a lot of outbound. We work on investment theses. We want to be in a particular space, in a particular industry, then we're going to reach out to companies like proactively if we want to reach out to them. We also have relationship with founders that we know for like a year or 2 years. We met them at C stage. It was a bit early for us, but now there is this kind of Series A or Series B where we now are comfortable, we can invest in them. So the relationship is really important. And then the 4th is the intro. I put it here because it's not obvious. And I think getting an intro is a bit better than the inbound. It doesn't mean that we're not looking at inbound, but frankly, getting intros from a VP, like a venture partner or a CEO, for example, that we have in our portfolio is something that we value a lot.
Or the loft.
a lot. So it doesn't like, frankly, get an intro, because it's sometimes you can get lost in emails or whatever. So of course, like Ask Alex is gonna be the perfect introductor for us. But it's always better, I would say, because then your file get on top of the list, your email get on top of the list, and then we actually spend some time looking at every single opportunity. Don't get me wrong, but it's always better. Like frankly, I have to say, because it helps as well, because the person that introduces you as well usually understands all the criteria that were listed a bit earlier, in the sense that he knows you're focusing on fintech, that stage to that stage. He knows where you are in terms of like fund deployment or things like that. The second thing to have ready, and I think that was mentioned during the last minute in the panel, is have a pitch deck ready. This is really the one piece of marketing that you want to have ready. I put here a list of do's and don'ts in the pitch deck, just to like really understand what like the common mistakes and the common things that like need to be included. It's great to think as a pitch deck as a resume, in the sense that it's not the whole fundraising is not going to be based on that, but it is your resume. It's what is going to get you to the interview, to the first call. Because at the end of the email from Alex, I'm going to ask him, sure, happy to meet with that person, but do you have a deck? Can I have a look at it before I actually meet with that person, so I can understand what you do better, understand where you are, and then focus my questions that are going to be way more efficient. So I'm going to cover them like very quickly so that we can move to the conversation. But in the do's, like what you want to reach is a document that is actually telling a story, right? You want a flow that is a bit logical. You want that aha moment when you close the deck. You've finished to look at all the slides. You cannot understand where the founder is coming and where he wants to go. So just think about storytelling here. You want to produce as well a document that is clear and clean, again, as a resume, like, you know, typos and stuff like that. You know, we get a lot of pitch decks, and it's easy for us to, I don't know, move to the next one if this is not like a clean document. And I would say that sometimes we miss, I don't know, like dates or sources on graphs or even scale. That could be very easy to add, and that can change a lot the perception of the deck. The third point is really important, and it comes back to the growth expectation. Highlight the opportunity and how big it can be, right? In that document, you want to tease the VC. You want to tell him like, hey, this can be huge, and we're looking for something huge. So it can be market sizing. It can be, it could be market sizing, it could be as well financial projections, but this can be used. Like if you show that you can do 2 million revenues in 5 years, you know, it's a great company, and that person is going to be way richer than me at the end of the 5 years, I'm pretty sure. But it's not VCable, right? It's not something that we're looking for. So show how big that thing can be. The team, really, really important. From pre-seed to Series A, B, like we bet on a team, we bet on people, like highlight yourself, what you've done before, who you are. Like who you are is really something that is important, like who is behind you, like put pictures, whatever, like this is like, we need to know who you are. And what you've achieved so far is going back to what we talked about a bit earlier, which is the traction, because execution capabilities are also behind traction, right? What you were able to build. Hey, I got to MVP, I got to X in revenue, I got to that amount of client. It's just what you've done so far. It can be revenues, but it can be a lot of different things. What you were able to achieve is so important. And it shows as well that you are cash efficient, for example, that you were able to build without raising like 30 million, something that that is very, very legit. Unit economics if you have, go to market, really, really important. And I think the last point is iterate. Like you'll not get to the perfect pitch deck in one day, but like this is not an art piece. It's not like once it's done, it's done. It's something you're going to go back to. Like just iterate. Like make modifications as you receive feedbacks from investors. I'll cover very quickly the don'ts. Just don't produce a piece that is too long. Frankly, I think VCs are well known for having ADHD. Sorry, so it's just like more than 20 slides. It's, I don't know, it's a bit long, and you can lose the attention of the reader. We don't specifically like when there's a valuation that is suggested. I think this is something that we can discuss, but the valuation discussion is going to come a bit later on. It's like putting a salary range on your resume again. It's just, you know, it's not exactly what you would like to see, and it's just offer and demand and where the company is at. And there's no, like, it's more an art than a science how to value a company at that stage. There's a lot of different criteria that are more qualitative than quantitative. So it's, you know, it's just tries not to suggest evaluation as well as an exit slide, right? It's something that we don't really like. Exit slide is a bit, I don't know, like, yeah, don't put an exit slide. Forgot to mention competition. Well, we focus on fintech. We see like hundreds of companies, and a lot of them are targeting the same subsectors or sub-industries. So we know the competitors. So not putting them here is not ideal. Like, what you want to show your investors how better you are, like why you're better than them. This is something that you want to show, because we know the others, and what we want to understand is why you and why not the others in the market. Undefined acronyms, well, this is something we're used to because we're fintech, so we know like what an MGA is in insurance, for example. But if you're pitching an industry agnostic fund, then it may not be the case, right? So think about defining acronyms. And the last piece is ask to sign an NDA. This is something that is really, really market practice for later stage companies. For early stage companies, just don't bother. Like, there's 3 different points that to back that sentence. The first one is operationally. It's taking us so much time to send an NDA, just because you have to review the NDA. You have to send it to the partner. So again, it can get lost in emails, and you don't want that. There's so many reasons to pass on a company. Just don't add that operational like obstacle on your way. Yeah, you don't really need this. The second one is, again, we're seeing so many companies that it doesn't really mean anything. Like, I've seen like the latest trend is like revenue financing, kind of revenue-based financing lenders. I've seen like 15s on the market already. And it's okay, that's my job to look at the 15s. I'm not gonna tell what I see from one deck and tell the others, but I've seen so many things that it's okay for me to take all the information, digest them, analyze them, and just like understand trends in the market. So it's, again, like it doesn't really mean anything. And I think the third point is the most important one, is we live and die by reputation as VCs. Frankly, this is not, I mean, this would be really, really counterproductive to share any information. So if there's something that is you don't want to share, just don't put that in your deck. Like, that's it. Don't put it in your deck, and share that a bit later on in the process, and that would be it. So I think I left it a bit more than 5 minutes. I'm sorry, but I tried to give an introduction and a bit more context on how to who we are and how we work.
Perfect. Pascal, do you want to add something? Do you sign NDAs, Pascal?
Yeah, I'll be brief. Aristotle said that in order to persuade someone, you have to include three very important things in your arguments and in how you discuss with that person. Logos, ethos, and pathos. And I believe that in order to pitch to a VC, you have to include these 3 things. If you don't have these 3 things, or if one is missing, you will fail. So logos is the logic. You have to have a logic to what you're building. You have to explain that logic. It makes sense. It's the value proposition, right? That's fairly obvious. The second is ethos. You have to link that logic, what you're selling, what you're building, to your experience, the subject matter expertise, right? It is you, and you're doing this because you can do it. If you don't have the ethos, you will fail. The third is pathos. Pathos is the emotions. It's the hope that you're bringing the VCs to your proposition, to your vision, to your business. If you don't have the pathos and you have the logos and the ethos, you will leave people cold. you have to get them to buy into your vision and love what you're doing. So remember, logos, ethos, and pathos are very important for a balanced pitch in writing or a balanced pitched verbally. Additionally, I think it's Blaise Pascal who said, I'm writing you a long letter because I didn't have time to write a shorter one. I think it's extremely important when you pitch to a VC, have few slides. Each of the slides have few bullet points. If you have a lot of words on the slide, you're gonna lose someone, right? So you have to spend the time to make what you're selling in your pitch, again, either verbally or in writing, simple and short and vivid. A couple of other things. I see most startups failing at explaining the value proposition and like going on and on and on into what they're building, but not getting to the essence of the value proposition. And then second, I see a lot of startups failing in fleshing out the addressable market, right? So you have a huge market, and then off of that huge market, you have like a sub-market that you're focusing on, and off of that sub-market that you're focusing on, you have the ability to address your portion of that market, and that's your addressable market. Explain that as simply as possible so that the VC has a clear understanding of what the path is in front of you for like traction. And I'll stop there.
Perfect, thank you. So we still have 10, 15 minutes for Q&A and people to interact. So please just unmute yourself and ask your question.
Yeah, I have a question.
Herman, go ahead.
Okay. For the pre-seed finance raising, how long does that take internally for a VC? Is it something they make a decision on faster?
Oh, yeah, I can answer that one. I think it really depends on the fund. Not talking about pre-seed specifically, it really depends on the fund. If you have an investment committee, if you have how long the process is. It's true that pre-seed funds are usually smaller funds with fewer people, and the decision taking can be a bit quicker. I would tend to say that. As well, you have less due diligences to run, from term sheet to closing. Of course, you have less due diligences. You don't have 5 years of financial to look at and things like that. So I would say that yes, it's a bit quicker. That said, usually for a full range fundraising period, I would say from first meetings to money in the bank, giving yourself a 6 month period is safe, is something that we tend to see. I don't specifically invest at pre-seed, it's usually seed to Series B, but it's safe to give you 6 months because conversations can last 1 month. Again, 1 month if you have more questions, and then you have the decision taking, and then the due diligences, and then you always have legal issues.
If I may add,
yeah.
I'm sorry to cut you off. Dermot, the answer is simple. It should be short. It has to be short and it has to be simple, right? Pre-seed, remember what I said between pathos, logos, and ethos. You're not going to have a lot to show because it's pre-seed. So you have to hook the investors, usually angel investors, not so much main VC funds, on your vision. If they're not hooked on your vision early on, chances are they're not going to invest in you. So it has to be short.
Yeah. Okay. Thanks, guys.
Thank you both for answering. Next question, please. Unmute yourself and go ahead.
Pauline, can I ask about scouts? They seem to be coming in as this sort of external, I don't know, before they're not part of the VC, but like Atomico has dozens of scouts all over Europe. What role do they play? Are they just sort of hunting to fill a funnel?
What are you referring to? Sorry about that.
Yeah, I can take that. Scouts are nothing new. The scout programs that you see are basically explicit, externalized networks for distribution. But frankly, those VCs don't rely on an explicit scout program, still rely on an implicit scout program, i.e. those entrepreneurs that are close to them, those third parties, startups that they previously invested in, and so on and so forth. So when you speak to a VC, you have to understand where that VC came from, how they came about you, if indeed those intermediaries were important in making the referral, and what type of referral it was. I can very quickly say that what I love first and foremost is to have someone that I trust with a particular subject matter expertise that introduces me to a startup that they know because it's the same subject matter expertise. These are great, scaling experiences.
Pauline, you want to add something?
Yeah, sorry, I didn't get the word you were talking about stacks. Very different thing. No, yeah, I can totally I second what Pascal just said, because it really is what is important to us, and it goes back to the Garden intro that I mentioned a bit earlier. This is what we have. So in terms of scouts, we don't have that, but we do have venture partners or CEOs that act as scouts for us.
Perfect. Thank you so much for the question, Dan, and Pauline and Pascal for the answer. Next question. Go ahead, Gabriel.
Thank you very much. Thank you very much for the presentation. Very, very interesting, Pauline. This question is to both of you, if you can help me on this. While being a co-founder of an early stage startup, I've been meeting and calling with VCs from all over the world, US, Europe, Israel as well. And of course, you cannot really pinpoint which one is correct. We have different definitions of what is pre-seed mean, what does seed mean, what does early stage mean. But a lot of times you come up to a VC's website to check if it's a fit, if it's a problem fit. And you can see, we invest early on, we're there to help you at the beginning, at the start. And then when you get on that first call, you get, okay, what are your revenues, or what is your KPI? Is there any specific definition, or I would be interested, of course, to have your view on when do you call someone seed, pre-seed, or if they need to attack VCs, you need immediately to have revenues or not? That's my question.
Yeah, I can start if you want, and then Pascal, you can add a few things. I would say that in general, I tend to say to founders, you call your round however you want to call it. It doesn't really matter. I don't care. Where we are investing is, we call it from seed to Series B, but by definition of seed is what expects from a company at seed stage is you have an MVP and you have you have an MVP. Usually you have maybe a startup traction, like a beta version, a pilot, a POC. It's not maybe commercial launch, but you have an MVP. And that would be maybe the difference between the pre-seed and the seed, is you have like a small startup traction and an MVP you can rely on. When pre-seed is usually, when you raise your pre-seed round, is usually to continue to develop your product because you don't have MVP just yet. So I would say that's a difference. And then when you raise like a late seed or early A, because you gotta have that type of definition as well, at that type of round, that would be, you have a startup traction. You already launched. You don't have a lot of clients. You can't show a lot of KPIs, but you've already launched. But just going back to VCs asking you KPIs, I think it's really, really important to answer them, because if you don't have KPIs, to say you don't have KPIs, but if you have some, it's important to share them.
Yeah, I would add, do your due diligence. You have to and be as brutal as the VC is brutal with you. Try and figure out who they've invested in, how they invest, and then be prepared when you have that call. And then even before that call, ask them point blank, what are the things that you're seeking in a very specific way that relate to where you are in your stage. So you don't have the nasty surprise of someone starting to ask you things that are completely inappropriate for the maturity level that you're in.
Thank you very much. That's actually what we've learned from it and started to do. We have that very clear cut first 30 seconds of the call, not to waste anyone's time, not the VCs and not the startup. Thank you very much for your input, both of you.
Thank you for your question, Uriel. Next in line is Ismail. Ismail, please unmute yourself and go ahead. If you can put the camera, it's even better.
Off. Sorry, unfortunately, could you hear me, Alex?
Yes, we can hear you.
Oh,
yeah.
We
cannot see you.
Oh, yeah, unfortunately, because I'm not in a proper environment in order to.
Okay, go ahead then. Shoot your question.
So sorry for that. So
go ahead.
Hi, Pauline and Pascal. Basically, I have a small question in relation to the team, because we all understand that team is important and it is a recurrent like a feedback that we seem to get. As you know, like when we start an early stage startup, there's a lot of risk. We don't know if the idea will work. Fortunately, sometimes we test the idea and within a short time frame, it works, and then we see a lot of momentum. People wanted to work with us, but we can't increase the team. It's a paradox. We can't increase the team because we managed to get early tractions. The early traction is not sufficient to hire people, but we know that cash could solve the team issues. With the cash, we could increase the team because we see people would like to work with us, and then they tell us we're just waiting for the seed financing in order to work with you. So how do you help the situation of early stage? Because it seems to me that this situation is not focused on maybe one early stage, it's common to most of the early stage. So how could VC sort out this solution?
A chicken and the egg question, Pauline. I don't know if you have a...
I was going to say that chicken it looks like a chicken egg solution that is not actually very funny when you're in it. Is of course you need the traction to raise money, and of course you need the money to be able to hire the team and have even more traction. So of course it's something that you understand way better. Is it possible that you're targeting funds that have like thresholds in terms of revenues or threshold in terms of traction that can be that don't necessarily are a quantitative threshold, but like more qualitative traction, so number of clients or type of clients or whatever? If you're not targeting funds that are pre-seed funds or money that can be raised at that stage, is that something that?
Okay, Pascal.
I don't know.
Okay.
Nothing to add.
Nothing to add. I mean, try to hire patriots and not people are joining you just because of the money. Maybe they are just, mercenaries.
Yeah, but thank you.
Try to give something back, like equity. So sometimes it helps. You give them equity with the promise that you're gonna getting Pauline or Pascal.
Exactly. I mean, if you're alone, it's a different thing. If you're like, usually when you hire people at the very early stage company, you don't pay them market rate because you don't have the money to pay them market rate, but you do offer equity. This is something that we can spend hours talking about, like strategy of how you like the remuneration package of the compensation package of your team, but definitely offering equity is something that is very important to attract and retain team members when you don't have the money to pay the market rate.
Do you mind if I just add one sentence?
Go ahead, please.
So paying equity, right, but based on the impact they bring into the company, because at one point you can find yourself that you give up part of your company for quiet people in the corner who are not doing anything. Sorry.
Yeah, that's a risk. but usually how it works is you don't actually give up equity, you give options. And then these options are vesting over time, and you usually have a cliff period that we call, in the sense that if someone and that cliff period is usually between 1 year and 2 years, and if that period person stays shorter than 1 year, they will not get their allocation at all. And if they leave after 3 years, they will get their allocation based on the vesting period. So you don't give them this full amount. And then you can find online, there are some ranges, acceptable ranges as well, on how much you should give to who, depending on the key, if it's a key person or not, if it's a C-level type of person, if it's a head of sales that is really, really important to you, or if it's, I don't know, like a junior person or whatever. So depending on the person as well, you would give a different amount. But yes, that's the goal. The goal is to incentivize your team and to retain them, right? And we have ownership targets on that. Like I can give you ownership targets at like seed or Series A, or that we have that. But the team usually needs to have like a significant portion of the company. That can range from like 5 to 10%. I think is something that is like seed or Series A kind of acceptable.
Sorry to cut you here. We're gonna go back and for closing the session, Pauline, Blackfin, I guess on the website they can contact you directly by email.
Yeah, by or LinkedIn. It works.
Or by LinkedIn. Pascal, same thing in the game venture.
Sure.
Thank you.
Super. Can you see the slides?
Yes, sir.
Super. So just at a very high level, and we sort of touched upon it before, but the idea that on which Fabric is really built, and is the idea on which we've built the thesis for investing into the blockchain space, or we call it sort of the open economies built on the open web, is that today's economies or today's business models are really built on closed economies that profit from surveillance capitalism, from a world in which users' data and users' content is really used to profit a couple of large tech corporations without benefiting the end users. And on the idea that all assets, identity, data, financial will be tokenized in the future and will be used in a very modular fashion in these open economies. And finally, that these open economies will be incredibly powerful in terms of setting incentives and aligning the behavior of its components. And this can dive into a whole bunch of different sort of routes that we can jump into, but for the sake of time now, probably won't dive into them, but it does show the layers of complexity that this thesis sort of comes to. But the core of it is really this evolution of the web. And the way we see it is that the internet originally was built on sort of three core layers with dedicated infrastructure. If you wanted to spin up a website, it cost you $1 million. You needed to have the physical servers to run the website. It was all really largely driven by desktop browsers, so there's a limited number of users. And it was really unidirectional content networks. It was news online, it was phone books online. It was maybe at some point even sort of e-commerce started shaping up, and you could, in a sort of unidirectional fashion, buy things from a certain seller. And sort of the model that grew out of that was e-commerce. So you had eBay, you had Amazon, that really came out of it. And then we moved on to sort of Web 2.0, which was ultimately a really closed version of the web. The shifts were that instead of having this dedicated infrastructure, we had cloud-driven infrastructure and cloud-driven computing, which meant that there was a huge amount of iteration and innovation that could happen at a very fast scale. You could spin up a website and scale the costs of that website as you went along, as you gained more and more users, without having to have that sort of initial upfront cost to it. It also moved mostly to mobile, which meant that not only did you increase the number of end users that you could have, but ultimately they all had sort of your website or your product in their pocket at any point in time. So the number of hours and the number of users went up. And it was driven by this sort of social element, which was that there was identity, reputation that was brought online. And so you could create trust via an intermediary and via these social networks. Ultimately, they were all closed social networks, which were really driven and controlled by a few large tech companies, which built sort of the advertising model, which was the dominant business model of Web 2.0. And today we arrive at what we think is the next wave of the internet. So call it Web 3, call it the open web, call it the blockchain space. But it's driven on sort of three other pillars of technology. One being that we have really pervasive computing at the edge of every sort of, or edge computing. So every device, every receptor, every mobile, every fridge, every car will have computing power and will be able to interact with this network of other devices, humans, machines, animals, cars, whatever you want them to be. And so that really makes it a modular setup in terms of where this data can be accessed. But most importantly, instead of having social networks, you have financial networks. You have built-in financial value. You've effectively weaponized software to make financial commitments via the ability to have provably scarce digital value. And so the emerging business model of this new wave of the web is ultimately digital assets. It is the provably scarce digital assets that sit on these networks. And so if you look at where that, there you go, where that brings us in terms of an investment thesis of how one can gain exposure to this new wave of the web, the way we see it is these sort of expanding circles, starting with the infrastructure and developer tools. These are base layer blockchains. So it's something like Ethereum, Polkadot, Bitcoin, or developer tools like Open Zeppelin and Radical, which allow anyone to build companies and products and projects in this open web. And this step above that, with this idea that you've effectively injected the ability to make financial commitments into software, and that you have provably scarce digital assets residing within these networks, is that you can have these open digital financial platforms and networks, which means that anyone can trade natively online with anyone else. And if you think back to sort of the original view of the internet, Mark Andreessen from A16Z sort of fairly notoriously said that the original sin of the internet is that we didn't include means of payment directly into the internet. And that has led to the sort of ad tech model that we have today. Well, today we have the ability to make financial commitments. I can send a stable coin or an ETH or a Bitcoin to anyone anywhere in the world without a third-party intermediary having to control that transaction. And so that expands to a whole bunch of different verticals. We think that today it's largely driven by the decentralized finance space, but in 5-10 years, this technology will permeate into every single vertical that we can imagine. Just like in 2000, there were internet funds, there were people specializing in investing into the internet. Today, there might be people specializing into blockchain. There might be blockchain-focused funds or crypto-focused funds. But in 10 years, every fund will touch this tech in the different verticals that they invest into, whether it's in the gaming space, where you have provably scarce digital assets that exist within gaming economies. And effectively, the mindset of a gamer shifts from expenditure, where I'm buying a skin just to show off compared with my friends, but can never sort of resell this, to investment. Because if I can resell that skin at the end and it might accrue value, then that will create an order of magnitude higher investment into these game economies. In the same way, for sort of entertainment and culture space, or the healthcare space, if every single bit of data, healthcare data that you have and you can provide to a network to benefit the network as a whole, and you can monetize that, that is hugely beneficial to the end users. Whereas right now, it's largely sort of siloed into the data warehouses of a few large biotech companies that are able to use that data without the end user necessarily knowing about it. And so we have some examples, but this is really the core and the nub of the thesis at Fabric. And in terms of just the final, it's not working. There we go. In terms of just timing, because I mentioned how important that was earlier on the call. In 2017, a lot of this thesis was too early. Today, you see just on sort of the Bitcoin front, you see massive corporations putting a huge amount of Bitcoin onto their balance sheet because they realize that the fiat system or the dollar or the euro or whichever geography they reside in is not a proper hedge against what might happen in the world. And so you have MicroStrategy, which quite famously put almost an entire balance sheet into Bitcoin, but even companies like Square and Twitter co-founder Jack Dorsey putting a large amount of money into this hedge against the inflationary nature of sort of today's economy. Equally, we talked about decentralized finance. Actually, this slide is outdated now because it says there's $24 billion locked in on Ethereum applications in the decentralized finance space. Actually, just checked this morning, that's closer to 30 billion today. So it's growing at an incredible pace. You can see the sort of size of the slope of the graph, where this money is being put to work in a trustless manner without third-party financial institutions. And that's an absolutely fascinating space because it provides access to complex financial instruments and opportunities that were just totally unapproachable to the majority of investors and asset holders. And it puts it out in the open. Anyone can participate in it, and the fees are regularly much lower than in the sort of traditional finance ecosystem. It of course leaves questions and concerns around how can you trust this if you're not a coder and you can't review the code yourself? What are the regulations and compliance requirements when you're looking to actually interact, not in this sort of utopian vision or view in a silo by itself, but rather actually integrate it with the financial ecosystem of today. And so that's where Pavel can probably jump in and share a lot of what he's seeing on making sure that these two worlds don't collide head on and create an explosion, but rather really intersect and work collaboratively to create something valuable for everyone. And so that's sort of a quick overview of the Fabric thesis, and I'd probably pass it on to Pavel here.
Thanks, Max. So frankly, I think it will be great to meet you guys in like 2017. So there will be probably different discussion as well that we have along the line. But I completely agree to what you just described, and I think that's great opportunity for anyone who is actually raising right now to go through this route. I mean, that's like it's I think it's a little bit less competitive in terms of projects. If you're creative, you can also build companies which are immediately worth a lot of money. So, and I think this is the future effectively. So it's rather building the future startups than relying on existing one, right? I'm coming from very much traditional sector, and when I saw actually first time Bitcoin and how it operates, and that there's a ledger underneath, public ledger which you can analyze, so I could do startup in the traditional, let's say, sectors, but for me this area was completely more exciting and more impactful, and frankly it's actually happen when it's real, right? It's actually happening at the moment.
Yeah, that's where I think a lot of sort of criticisms of the space come, saying that, oh, it's just tech for the sake of tech and there's nothing happening on top of it. But as mentioned earlier, Uniswap, which is a project that a company that is built by 7 people that was launched 2 years ago, processed $6 billion worth of volume over the past week. Yeah. I mean, that's incredible. That is competing. That is actually as much volume as Coinbase, which is a 8-year-old company with, I think, close to 1,000 employees, which will probably list on do an IPO over the coming months, and that is sort of estimated around a $50-60 billion valuation. The fact that a small team that's nimble, that intersects the space at the right time, at the right place, and interacts with the right actors, can create so much value, I think is mind-blowing, but it's also really inspiring.
Do you mind if I interrupt here? Max,
yeah.
I was seeing your slide. I don't know if you can go back to the slide where you mentioned the web 1.0, 2.0, 3.0.
Yep, let me bring it.
There was something about when you move from the web 1.0 to 2.0, this was very business driven. There were not many restrictions in place. And in the end of the day, the authorities tried to restrict, and then they enacted the GDPR, a lot of data protection to limit all the open social networks that were going on. And now from Web 2. Web 3, this is we are entering into areas which are very regulated. So it's a completely different challenge because there was no regulation for Web 2.0. It was a business and money was driving investments. But for Web 3.0, I mean, digital assets are great, but these will collide a lot with the regulators in each country, with taxing and all of that. So will there be a much bigger battle there to see this go through, or are you seeing any particular steps that tell us that the governments are open for this? Because when we speak of digital currencies, there's a lot of states, and recently even the International Monetary Fund also warned about the money laundering and all that. So how to overcome, and will not this be a legislative limitation to all the technology that is already out there?
Yeah, I think it's a really important question, and there's a few ways to come at it. So first of all, I think it's important to differentiate between digital assets that represent equity-like instruments versus digital assets that are trying to replace currency. The moment you talk about digital assets that are trying to replace currency, I think nation states have a legitimate reason to be worried about it, because the issuance and control of currency is the one sort of control over population that a nation state has, and so they need to be very careful about that. And secondly, when you talk about sort of money laundering, and a lot of sort of quite often the sort of illicit activity is thrown into that bucket as well. I always wonder sort of from which perspective that comes from, because if you're going to be trying to do any type of illicit activity, surely you prefer using cash, which is totally untraceable and does not have a digital footprint, versus a totally transparent, open ledger of every single transaction that has happened. And so from that perspective, I don't totally agree with the argument, but I do think it's an important sort of point to touch on. And actually, so
let me add on this, you know, what you said about cash, you know, versus digital assets, you know, crypto and, you know, the money laundering. I think it's not such a simple answer. You know, we see huge increase in like illicit activities, and some of the sectors like ransomware are actually almost based on, you know, crypto effectively, right? And this is definitely growing. But at the same time, what you said, it's true. It's like, you know, in terms of, you know, tracing, you know, in terms of preventing money laundering, in terms of recovering stolen assets, in terms of removing illicit actors, that's the, you know, technology like ours, you know, it's completely unmatched in the traditional finance, right? It's like, you know, we are talking about, like, you know, every bank's having their own system versus, you know, you have system which oversee all the banks, right? And imagine, you know, when you crunch this data, you know, how much, you know, excellent results you would have. So, you know, I think, and, you know, from the innovation perspective, almost every aspect is being addressed, like, you know, frankly. And, you know, like what I see with this open Web3, you know, people, you have people who are very aware of regulations. You know, there's a lot of discussion around, you know, like regulations. Sometimes it's okay, we don't think we are falling into any regulations, or, you know, they say like we see great opportunity in actually, you know, creating fully compliant platforms, right? So that's something which is evolving dramatically. You know, my background in traditional finance was quite a lot around, you know, payment processing and payment processors, and the conversation with that people was completely different. Like they're trying to actually minimize any cost related to compliance. With the crypto, with blockchain, is actually, you know, quite opposite.
And just to add to that, and sorry, I started with a sort of straight rebuttal instead of jumping to what I think is the really exciting element of it, is that we live today in a world where compliance is done post factum. You do your transaction, and later on, someone might come check whether your transaction was compliant or not. And now that you have these digital assets that can be programmed, you can move to live programmatic compliance. You can make sure that a transaction, and you can sort of hard code this in that it cannot be done any other way, that a transaction of a certain asset cannot be sent to an Ethereum wallet that is not being verified to belong to this and this person, that check their ID, that passed the KYC and AML tests in this jurisdiction that they are in, and it makes sure that it fits with the sort of jurisdictional compliance that they need to be fit with, and on the same time on the sender as well. And so you move from a world where everything is done post factum on a not sort of automated basis, and where not every transaction gets checked, towards a world where everything is done live, programmatically, on every single transaction. So you move from know your customer to know your transaction as a sort of mindset almost. And that, to me, I think opens a whole amount of opportunity that can be tapped into by the financial ecosystem today. And I think that's why a lot of the financial ecosystem players are getting very excited about what the potential of this technology is.
Okay, we also have a question from... Sorry.
I just wanted to raise the argument that you know, the governments need to align with this. The national powers, the international powers need to be, you know, need to buy this message as well.
Yeah, no, and I think that there's an element of sort of a part of the sector that has really hardcore views on the fact that the governments don't matter in this equation. I was actually on a call with Pavel today on Monday, and we I think shared thoughts that is a vision that will never play out. I think if you want this technology to be successful, it needs to interact with the financial ecosystem of today, but also the governments of today. And that's absolutely the case. And that's why I think it's really important to highlight the benefits that this technology can bring to what governments and financial ecosystem players are doing, rather than trying to show them that they can't do anything to stop it. The benefits are heavily outweighing, I think, the costs that might come with it.
But at the same time, Max, I mean, the outliers or the hardcore, crypto people, they are the guys who are the most innovative in this space. So it's almost like, you have the innovation like Uniswap. This is like you said yourself, it's great innovation, but these guys are hardcore, right? This is like, they don't think they need to have any compliance whatsoever, right? So that's something which is which we see, like innovation is happening very fast in this space, dramatically fast. Regulators are left behind, not to mention regulations. So that's actually I think we are when we talk with regulators around the world, they still think that there's Bitcoin only, right? Majority of them, and they still think that Bitcoin is like criminal money. So that's majority of the regulators.
Can you hear me?
Yes, please go ahead.
Okay, no worries. Thank you very much. I had a question because I'm planning to. There's this project I would like to move on, but I was wondering at this stage, because we have like a lot of different technologies when it comes to digital ledger in general. So I was in here listing like Ethereum. You have like also Stellar, BigChainDB, and so forth, Hyperledger. And each of them have you have pros and cons when you want to move on in these technologies. But now my question is like for let's say a new startup that wants to go forth and launch something that in a tokenized space. I'm not talking about currency in here, clearly not. But if we want to, let's say, launch a new product, a digital product that is actually tokenized and drive a new economy around this tokenization, what kind of technology is the best to invest in a more sustainable, in fact?
I think you need to answer yourself what you want to achieve. Whether you want to. I mean, you have Ethereum, let's say, blockchain, which has a lot of adoptions, and majority of the DeFi space would be running on Ethereum. So if you want to go into this path, that's one way, But effectively, if you want to do microtransaction or Ethereum, don't go into this space, right? Because the cost of transaction on Ethereum is dramatic, So you rather go into the Polkadot or RSK or any other sectors where this cost is actually much lower, but the adoption is also the user base is actually much lower. So I think it all depends. If you're talking about banks, financial institutions, I would say that Hyperledger is right now one of the major blockchain which is being adopted, what we see at least. So that's another angle. I mean, it all depends what you want to achieve. The differences, and as the tough part is that you not necessarily it's not easy to find these differences unless you are fully in the sector, right? So unless you fully understand, like from our perspective, for example, Stellar, which we know that it's great project, etc. But it's very difficult to establish really functioning and fully sustainable Stellar node. That's something which you need to take into consideration.
Yes, that's my point. Another point is also is the company behind this or the organization behind this is going to stay like in 2-3 years, because you don't want to invest something and then the technology itself or the company backing up this technology is not there anymore.
And to add to that, and sort of in terms of full disclaimers, I am biased towards Ethereum, Polkadot, and Near from our investments, but I think it's important to take into account a few elements, and Pavel sort of touched on them. If you're looking to build a financial primitive or an application that uses 3 or 4 of these financial primitives that exist in the DeFi space. Right now, they all exist on Ethereum. They're nowhere else, if we're honest with ourselves. And so you want to be building on Ethereum and being able to interact directly with them. It does come with a drawdown that Ethereum, especially right now, the gas prices right now are at 119 Gwei, which makes it extremely tricky to transact if you're doing low value transactions. If you're dealing with loans, mortgages, credit, which generally don't have high throughput of transaction, no high volume, but rather have low volume of high value transactions, then Ethereum is perfect for it. It's probably the most secure smart contract platform, actually most certainly the most secure smart contract platform right now. You are able to interact with all of these different ecosystem players. You can use the financial primitives that exist on Ethereum. And if you're sending or taking a loan of $15,000, $20,000, $25,000, you don't care if you're paying $20 in transaction fees on that. You'd probably pay more with a bank. But if you're trying to build a game that requires a high throughput of 50 cents, $1, $2 transactions, then Ethereum is totally unusable right now for you. So there's different sort of solutions with that with layer 2. Based on optimistic rollups or zero knowledge rollups that are sort of being built up right now. But most likely you want to shift over to something like Near, which is focused on a higher throughput of transactions with maybe slightly lower security, or something like Polkadot, where you have a bunch of different subchains which can have certain characteristics for different use cases. And the way I like to think about it is sort of this 3-dimensional space or axis where you have security, decentralization, and scalability. And if you're trying to recreate money, you probably really care mostly about the security of it, because it is the most important element. If you're trying to recreate an in-game economy inside of a sort of gaming environment, it doesn't need to be totally decentralized, and the security is not the most paramount importance, but rather you want to make sure you have scalability so that you can scale to 100 million players. So it's sort of a trade-off, as with all things, in that sort of trilemma.
Yeah, thank you for sharing.
Okay, guys, we have time for one more question. Who wants to go first? One more question. Who wants to go first and last? Vostek? Okay, we are going to keep the room open for 2 more minutes, and then we're going to bring you back to the main session, main hall. So we have 2 more minutes for you guys.
That's a good question. I don't know if you can hear me. Hey, Pavel, nice to see you. Thought I'd come in just curious, because I think the conversation is absolutely fantastic. Curious kind of, with DeFi right now, so much of the experience is fixed income. You're already talking about kind of bonds in the other world. How soon before we really start seeing kind of what FTX and what they're doing with sort of Oracle-based stocks and that kind of thing? How soon before we see that in sort of a really truly regulated, in a sort of clearing behind it, that kind of thing? I'd love your perspectives on that, both from regulatory side and investing side. So I can take it on mute, but yeah, thanks for the conversation.
I think just briefly, and then I'll pass over to Pavel, but I think FTX could not have found a better timing to announce their Blockfolio launch of synthetic assets than the day that Robinhood was put under fire due to the GME trading stopping. And I don't think it was on malicious intent of Robinhood, but it was just due to the sort of microstructure of the financial ecosystem that they're operating in, that they just couldn't handle those transactions and had to put them on hold. And so I think there's a few interesting projects that are building synthetic assets. Synthetics is one of them, UMA, then FTX with Blockfolio now. That is most certainly one of the elements that is required for mass adoption. You mentioned sort of yield opportunities that exist right now. I'm astounded that there's not a massively adopted sort of, I like to call it API for APY, a company that takes capital, puts it into these yield generating strategies on DeFi, and provides it to a Revolut, a Monzo, any neobank, any sort of consumer facing application, and tells them, hey, look, we've taken insurance on chain against the smart contract. We offer yield. It's currently between 5 and 10%, which is 10 to 20x better than what any sort of current financial institution can offer you. Why don't you offer it to your end consumers? And I think that will drive mass adoption of decentralized finance, because right now decentralized finance is, I don't know, if we're optimistic, call it 50, 100, maybe even 1 million users, but it's not 100 million users, it's not 1 billion users. And that's the level of sort of consumer adoption that we need to make this a true success. And the same will follow with synthetic stocks as well. I think we live in a time